That's easy.
All right, guys, I think we're going to go ahead and get started here this evening. First of all, I want to thank all of you guys for coming out. If you enjoyed this meeting, thank the person that called and invited you. This should be a pretty good meeting. Brian's been up to speak for us several times the past few years, and it's always been good. Obviously, markets are weighing heavy on people's minds, and it's cold, and we wanted to get out and eat something, I guess. Hopefully that was satisfactory. We got a lot of people here tonight from Team Ursa Farmers. We got Roger Hugenberg running around, General Manager. Got Kent Buckert in back, Operations Manager. We got Scott Meyer, Grain Merchandiser. We've got Heather Hall from the Ursa office. She is the Assistant Controller. If you guys don't recognize that face, she might help on the phone with settlements and estate issues. We've got with Crop Insurance, Chris Scorzat and Jennifer Wood running around. We've got Larry Spurgeon in Grain Origination, Wes Hornback with Feed, Michael Hicks in Seed. We've got Ray Ternier, the Bowen Manager here. We've got Terry Schlitman, the Meyer Manager. We've got Kyle Starman from Lorain, as well as Dave Neal and Derek Green from the Camp Point location. And as well as myself, Tim Ellebrock. For those of you who don't know me, I'm Tim Ellebrock. In addition to that, we've got Board President Scott Gray here, as well as Eric Cassins. And we've also got Sean Lewis and Chris Buckert with Lewis Hybrids here. So I'm going to go ahead and kick this over to Brian and let him get done and get you guys out here this evening. Thank you.
Thanks. Thanks, Tim. We probably need to open up the doors in the back because there's a lot of breathing mouths in the room and there's a lot of hot air that's going to come from up here. So maybe we need to cool it off from the back. I've been doing a lot of meetings over the last 60 days, partly because of the program that we offer through Ursa, and that program continues to grow. But in the last 2 months, I've probably put on 20 or 25 meetings that are similar to this. Most of them aren't quite this large, but similar to this. One of the goals that I had when I started off these meetings is I wasn't going to start off talking about what the problems are. Everybody knows for the most part what the problems are. I'm going to point out a couple of things. And when I say problems, I mean prices, where we are today and kind of why we're here. The presentation that I have is not going to dwell on that part of it. We certainly have an oversupply situation of grain in the markets today. We have an oversupply of a lot of commodities, and the result of that is just this buildup in acreage and overproduction that we've had the last several years. We can really narrow down the problem in the grain markets in particular to 2 or 3 items that I don't have on any chart. One of them is that in the last 10 years we've added 174 million acres to global production for corn and soybeans. That's one of our biggest problems. 174 million acres is equivalent to the entire United States corn and soybean crop. We've added it all over the world. We've added it in Brazil, we've added it in Argentina, we've added it in the Ukraine and Russia and so forth. We've added it because $5, $6, $7 corn allows it to be grown profitably in a lot of other parts of the world. Another thing that has changed, and this is going to test some people's memory, it's going to test my memory too because I don't have all the dates memorized, but think about the government programs over time. And you can go all the way back into the 30s and 40s and the way some of these government programs started. And you think about set-aside programs, you think about PIC certificate programs, you think about CRP programs. Most of the programs until 1996 were geared towards either idling production or taking supply off the market via government grain-owned stocks. We have since switched in 1996 to a freedom to farm, and then also the revenue-backed insurance policies that we have today. We no longer have, the U.S. government and the USDA no longer has a supply control like they had prior to 1996. That's been a key change that most people don't think about. We've taken, and I think it was I've got in my notes, but I think it was in 84, 85, over the course of a couple years, we took out 39 million acres of production in CRP, in the initial enrollment. And so we've been gradually taking those acres out the last 5 years, increasing corn and soybean production, and also laying on top of that the revenue insurance programs that we have today that are much different than they were prior to '96. So the supply controls have changed in the United States. That's also one of the leading indicators, especially here, into our oversupply problem. We need to figure out ways of not just increasing demand, but seeing and rationalizing some of the acres we're putting in the ground, especially in areas outside of the core corn belt. We don't need to be growing corn in western Kansas. We don't need to be growing corn in western Pennsylvania, things like that, where it's not as economical to do so. But some of those things have built onto the problem of oversupply that we have. Another thing that we've done, we've had 3 years in a row where anywhere in the world that is a major producer of corn, soybeans, and wheat has not had any significant weather problems. So we have had in the United States 2 consecutive record soybean crops. We've had 3 record corn crops in 3 years, not consecutively, but the last 3 have been records. And that's been true in the world. So when we sit back and look at, okay, what's the problem? Why are we at 350, 360 corn when it comes to futures? It really comes down to we have had this cycle of buildup in demand. We've had an acres rationalization or acres build to get to that point. And now we're seeing demand, even though it's still growing, it's overshadowed, and I'm going to point out some of the positive demand features that we have, but it has not. The demand is a slow growth. It's like population growth. I mean, it's a couple percent every year. But when we see our acres increase from a core acres base 20% over the course of 5 years, it's just taken time to catch up, and Mother Nature hasn't given us a break from the world's production, not just the United States production. Now, Tim, he forgot the clicker, so I'm going to come over here and blame Tim for everything. I also failed to mention, thank you for coming. Tim said thanks as well. This is a great turnout. I hope you guys came for the food, but when we look at the programs that we've done, which we're going to talk about in the end, I do want to say thank you to everyone who's been involved in that. I mean, the growth that URSA's had in that has been tremendous. We're proud of the fact that URSA has chosen us to do some of these programs. So certainly thank you for that. Trust with your marketing. Another feature in the market, and this I don't want to promise this is the only bearish thing that I'll say, but this is really about the only bearish slide that I have, and it has to do with the US dollar. Now, I know whenever I've sat through many presentations before, and I sit through a lot of them, I give a lot of them, and I sit through a lot of them, one of the first 2 things anybody talks about in a presentation like this is generally either crude oil or the US dollar, and especially the last few years. And whenever somebody starts talking about the US dollar, unless you are an economist by trade, sometimes it's difficult to put into corn and soybean terms and a real relevant conversation what the strength in the US dollar has done to our markets. The first thing we've got to realize is when we're talking about the US dollar, we're talking about exports. Corn and soybeans that we consume here in the United States are not influenced by the US dollar because it's bought, it's sold, all the inputs, all the output of the plants is all bought and sold in dollars, so it really doesn't matter. When we talk about the US dollar hurting our competitiveness, our demand, we're talking about exports. We're talking about global exports and our competitiveness with that. If you look at this chart, there's going to be 2 lines. There's a green line and an orange line, and it's 2 separate charts. The green line on top here is corn futures in Brazilian reals per bushel. The bottom half of the green is soybean futures in Brazilian reals. The orange line is in US dollars per bushel here in the United States. About 15 months ago, we started to see a real divergence in the value that the producers were getting paid for corn bushels and soybean bushels. I converted all this to bushels just to obviously make it relevant because they typically quote in tons. But you started to see this big divergence. Prior to 15 months ago, these prices tracked very, very well. And then 15 months ago, we saw this big change. That change was very specifically the US dollar. We've seen the US dollar rally over 20 to 25% in relationship to, in particular, the real in this case, but also other world currencies such as the Argentine peso and Russian ruble in particular. For wheat, that's a big deal. When you look at this particular chart and you look at what does this mean, this means that at the same time, your prices here in the United States for corn and beans over the last 15 months have been relatively flat to downward sloping, okay? We've been in this range of 4.25 to 360 for quite some time on the front month. We've been flat as the previous chart slowed. At that exact same time, Brazilian soybean farmers and Brazilian corn farmers have been seeing anywhere from a 30 to 45% price increase. And that is strictly because of the lower devaluation of their currency in relationship to the US dollar. When a world buyer comes and wants to buy a Panamax beans, he's going to see how many beans can I get. If I'm Japan and I'm buying it in yen, how many tons can I get for my yen? And it doesn't matter where it comes from. I'm going to buy it where the world currency is the cheapest and where the net price for that tonnage on that vessel gets me the most product. And that's where our competitiveness has been failing. That's where our strong US dollar has been hurting us, has been in world trade. That doesn't really say why our US dollar has been high. That just explains what's been the result. The why our US dollar has been high is because we still, in the United States, are considered one of the safest places to park money around the world. The view of the strength in our economy, you can look at things like default risk. We don't think about default risk from a US government standpoint. Other countries around the world think about default risk of their government. So when you see money floating around in terms of currencies, the United States is always considered a safe place to park your money. That needs to start to change when it comes to us becoming more and more competitive with South America. Either they need to be viewed in a more positive light, that they're stabilizing those countries, in particular Argentina. They just had an election that changed a lot of things. Is that country stabilizing? Is Brazil stabilizing? Is Russia stabilizing? And today that answer is no, we don't think so. We're still chopping around at the top end of this dollar range. So if you're looking strictly to the US dollar, which is one of the places that we look, it's not the only place. If you're looking at the US dollar as a place to give us a leading indicator to things changing, one thing that's positive to price, or would be positive to price, is to see this start to downtrend. And trying to find a reason for that to happen today is difficult. I'll be honest with you. It's maybe 500 points down in the Dow today is one reason to become less confident in the United States financial markets. Maybe seeing 3 or 4 or 5,000 points come down in a month is going to cause people to say, wait a minute, maybe I don't want all my money parked here in terms of US dollars, so they start to diversify out that investment. So it's kind of a double-edged sword, but as we start to look more shaky, whether it's financially, whether it's in the energy markets, which those two are certainly shaky areas, that can actually cause downward pressure on the US dollar, which in a backwards way is very positive for grains. It actually helps us be competitive. The next two slides are going to get specific about corn, and one of the things that has been completely overshadowed by the supply story that we have, and I've got a slide or two that kind of graphically shows the supply issues, but one of the things that's been overshadowed significantly in corn is actually a pretty positive story. And this slide here shows world exports for corn. It doesn't matter where the corn comes from, it doesn't matter where it goes, as long as it went from country A to country B, it's considered an export, or an import, whichever side you want to look at. And when you look at these bars, the blue represents the United States portion of that particular year. We start in 1990, we go to the present. The blue is the United States share of all world corn exports, and then you see Argentina, Brazil, and the Black Sea in these other colors as you get further to the right. That blue line shows the United States share of all corn exports. You go back into the 90s, even through middle 2000, 2004, 2005, on average, the United States made up somewhere between 65 and 80% of all corn exports around the world. So if it went from country A to country B, between 65 and 80% of the time, it came from the United States. We have been always, until more recently, the primary source of corn to the world. When you look at today, the last 3 years, we've been hovering around 40%. Our share of the whole pie is 40%. And you look at who's come up and taken that share It's been Argentina, Brazil, and the former Soviet Union. And actually, prior to 2002, 2003, the only country we really competed with was Argentina. But now we've got Brazil in a very big way, and the former Soviet Union, which is the Black Sea and the Ukraine area, has come in. If we, there's a couple points you can make on this. One, how did this happen? I mean, if we start asking questions, how did we let the world come in and take 25% share of a corn export market that we had such a tight hold on prior to that? The answer is pretty simple. It's ethanol. We needed more here. We didn't have as much available to sell around the world, and as a result of our ethanol demand growing from just under 2 billion bushels to about 5.1 billion bushels now, we allowed, through $5, $6, $7 corn, the rest of the world to fill the void. When you look at this chart, forget about all the colors and forget about all the countries. If I told you all this was a chart of corn exports around the world, that's a pretty good looking chart. We continue to need 2 to 3 million tons more corn every year just to feed a growing population, just to feed a higher percentage of protein going into diets, especially in Asia. China's one of those drivers, but it's also Southeast Asia, Malaysia, and countries like that continue to grow more and more meat, and then therefore the corn demand and soybean meal needed for that. So our corn demand story from a world trade perspective is strong. It's very strong. The challenge that I see is, how do we get back 5%, 10% of this share? How do we go from 1.5 or 1.6 billion bushels of corn exports back up towards 2 billion bushels? One of the biggest years the United States ever had in corn exports was 2.2 billion bushels in 1 year. You go back to 1990, that was bigger than the entire world corn export program. Today, we're exporting around the world 4.2, 4.3 billion bushels. How do we get another 10% of that? How do we get 400 million bushels out of that? Part of it's happening right now. It's price. We still have today the most efficient logistical system in the world to get grain from the production areas of the country to the deficit parts of the world. Our river system, even though I know the locks and dams are 50, 60, 70 years old, and we have some challenges when we start looking at our lock and dam systems, but we still can get grain from the central Illinois area right here down to the Gulf, 30 cents, 35 cents a bushel. Nowhere else in the world can you do that. So our production efficiencies, we have the highest yields in the world, we have some of the most efficient logistical systems in the world. We also have some of the highest land in the world, so we have some offsets there. But when it comes to efficiency, we can still get it to Japan cheaper than anybody else today. We can still get it to South Korea cheaper than anybody else today. We just have to work through the excess supply that's sitting in some of these other countries. I don't want to suggest that 350 corn is a good thing, because I know from a cost of production it is not, and I know we're all seeing this as a very difficult time profitability-wise on the farm. But one of the things that 350 corn is going to allow us to do, and even up towards $4 is going to allow us to do, is going to allow us to start to grow this export program. That's a good thing in long term, because we're not going to see 2 or 3 billion bushels come at us again like ethanol provided over the course of 10 years. We're just going to see that gradual growth that's 50 to 100 million bushels every single year in the export market, and then just some gradual growth in ethanol because of just gasoline consumption. So the old saying of high prices cure high prices, low prices cure low prices, those sayings are true, and there's a lot of merit to them. It's just a matter of how long does it take to kind of reshuffle the economics around the world. So this is really a bullish story. It's just how long it takes to evolve and how quickly we're going to get back more of the share of that export business that we've grown accustomed to. When you look at China, whenever I've talked about China in the past, and I know I've done it at this meeting in the past, it's usually been in the context of soybeans. And there's no doubt China is a significant player in soybeans globally. They're the significant player when it comes to soybeans. But this particular slide, and don't worry about all the numbers on top, they're just there to make you go cross-eyed. The bottom chart is all I really want you to focus on. How many people remember